Here is what most new authority carriers get wrong about insurance. They budget for the number they heard on a podcast in 2022, not the number an underwriter is actually going to put on paper in 2026. You will hear $6,000. You will hear $8,000. Someone in a forum will swear they got primary auto liability for $5,400. None of those numbers are useful to you because they describe a different operating cycle, a different loss environment, and almost always a carrier with 3 or more clean years of loss runs behind them. The honest year one number for a solo over-the-road operation with one tractor, one trailer, and a clean MVR is $12,000 to $18,000 all in. That includes primary auto liability, motor truck cargo, physical damage on the equipment, non-trucking liability, and general liability. If your MVR has points, if your CDL is under 2 years old, if you garage the truck in Florida or northern New Jersey, you are on the high end of that range or above it. Treating this as a $6,000 line item is the single most common reason new carriers run out of cash in month 4. Let me walk you through how this actually breaks a budget. Carrier gets the MC, pays the registration fees, buys a used tractor for $60,000, and budgets $8,000 for insurance because that is what the broker on YouTube quoted last year. Real quote comes back at $15,400. Down payment at bind is 25%, so $3,850 hits the bank account immediately. Now the monthly installment is around $1,140 for the next 10 months. The carrier did not budget for either number. They were budgeting $667 a month flat. So they bind the policy because they have to in order to book freight, and they enter month 1 already $2,000 behind on cash. By month 3, one slow week from a broker who pays net $45, and they are skipping a fuel card payment to keep insurance current. This is not a hypothetical. This is the default path when the insurance line item is wrong by 50%. The right approach starts with shopping 3 trucking specialty brokers in the same 2-week window, not general commercial brokers who will either decline new authority outright or come back with one non-competitive quote because they do not have the carrier appetite to place it. Trucking specialty brokers carry appetite with the underwriters who actually write new authority, and the spread between brokers on the same risk is routinely $2,000 to $5,000 annually. Pull all 3 quotes inside 14 days so the MVR and underwriting database pulls cluster instead of creating a trail of repeated inquiries over months. Budget the high end of the range. If you come in lower, that is upside. If you come in higher, you already planned for it. Carry $1 million in primary auto liability and $100,000 in cargo as your floor. The federal minimum under 49 CFR 387.7 is $750,000 for general freight, but no broker books freight at that number. $1,100,000 is the practical floor. Plan for 20 to 25% down at bind, with the balance financed over 9 or 10 months through a premium finance company. The finance charge will add a few $100s to the total, but preserving cash through year 1 matters more than the discount you get for paying annual in full. The insurance line is one piece of the year 1 compliance stack, and the rest of that stack is where new carriers also bleed cash through scattered vendor fees, missed deadlines, and reinstatement penalties. Cypress Authority Services consolidates the ongoing compliance pieces under one operator, so the carrier is not chasing 7 different login pages. The Unified Carrier Registration Annual Renewal, the MCS 150 Biennial Update, the BOC 3 Process Agent Maintenance, the Heavy Vehicle Use Tax Form 2290 filing every August, the Motor Vehicle Record Annual Pull on every driver, the CSA score monitoring against FMCSA's safety measurement system, the Drug and Alcohol Consortium enrollment, the International Registration Plan apportioned renewal if you cross state lines, and the International Fuel Tax Agreement quarterly returns. These are not optional. They are the ongoing cost of holding authority, and each one has a deadline that, missed, costs more in reinstatement fees than the original filing cost. Cypress runs these directly against the regulatory portals, not through wholesale aggregators that mark up the wholesale price 3 or 4 times. That direct build is the reason the line items stay predictable instead of drifting upward every renewal cycle. So here is the single action takeaway. Before you accept your first load, before you sign the broker setup packets, sit down with a real calculator and write out the year one insurance budget at $16,000. Not 8, not 10. 16 in the middle of the realistic 12 to 18,000 range. Add to that the Unified Carrier Registration Fee, the Form 2290 Heavy Vehicle Use, tax of $550 per truck, the International Registration Plan, apportion tags based on your declared miles, and the Drug and Alcohol Consortium annual fee per driver. That is your real year one compliance floor. If a broker quotes you $8,000 for insurance, ask them what underwriter they are placing with and what the down payment is. Because either the quote is fake or the policy has gaps you do not want to find out about during a claim. Year 1 is the expensive year. Year 2 on clean loss runs typically drops 10 to 20%. Year 3 drops further. The number you pay in month 1 is not the number you will pay forever, but it is the number you have to survive to get to the cheaper years.